Good afternoon, ladies and gentlemen, and welcome to the Trident Royalties PLC company update investor presentation. Throughout this presentation, investors will be in listen-only mode. Questions are encouraged. It could be submitted anytime via the Q&A tab situated in the right-hand corner of your screen. Simply click Q&A, scroll to the bottom, type your question and press send. The company may not be in a position to answer every question received during the meeting itself, but the company review all questions submitted today and publish responses where it's appropriate to do so. These will be available via your Investor Meet Company dashboard, and you'll be notified once they're ready for your review. I'd also like to remind you that this presentation is being recorded. Before we begin, we'd like to submit the following poll. I'd now like to hand you over to Adam Davidson, CEO, Martin Page, CFO, and Julian Bochet, Vice President of Investment at Trident Royalties PLC. Good afternoon.
Thanks, Paul. And I will flip the presentation on and drop the cameras while we go through it. And I'll try to move through it as quickly as possible to facilitate as much time for questions as we can have. So the point of today's presentation, obviously, is to go through the transformative transaction that we announced last week. I will, of course, touch on our existing portfolio because I think that puts it in the right context and really drives home, I guess, the intent behind this acquisition and what it does for us and sort of the re-rate that we'd expect off the back of it. So I'll touch on both things. And I recognize that not everybody's familiar with the Trident story and hasn't been following us since the beginning. So I will touch on, before getting into the transaction, the existing portfolio, I will briefly go through our strategy and the mining royalty space in general, just to make sure that everybody has that context. There's quite a few disclaimers here. This presentation is available on our website, so I will point you in that direction to both the website for the presentation under investor downloads, as well as the RNS announcements that had most of the context about the deal, all available on our website. So you can go through the disclaimers at your leisure. So for those that haven't followed the story from the beginning, Trident Royalties, we listed almost exactly 18 months ago now, listed in June of last year, with the intent of building up a portfolio of mining royalties and streams to give exposure to the sector from that royalty perspective, which was an offering that we didn't see out there available in the space. Now, my background and the background of our team in general is in mining private equity, where we wrote quite a few royalties and streams over our careers. And what we'd come to find is that when it came time to monetize those assets, working for a PE fund, you've got a fixed life of the fund, and you need to exit within a certain time frame. There was really not a natural holder in most cases for some of these royalties, particularly if they were non-precious metals royalties. You were sort of left scratching your head on who you could sell those to and where was the natural holder of these assets. So that was really the genesis, at least from my perspective, was to try to build a company that became the natural holder of all these royalties and gave exposure to the broad sector through a diversified holding. Now, I suppose taking a step back in terms of what our royalties, to many of our shareholders, you've heard this a dozen times over, so I'll keep it brief. But effectively, a royalty is not dissimilar from a royalty in any other sector. I know there are a couple large sort of music royalty companies listed on the London Exchange. A mining royalty is not vastly different. It entitles the royalty holder to a percentage of the revenue of the underlying asset. So rather than a song, in this case, it's over a mining project. Typically, it's over certain parcels of land that cover the project area, and that's an important point. Some of the benefits of royalties are that, obviously, by getting exposure to the assets, their revenue line, getting a cut of their revenue, you're getting exposure to the top line of the profit and loss statement. So just revenue. You're not exposed to the line items underneath revenue, which is most importantly operating costs and capital costs. That's the sort of exposure that equity holders in mining companies get. So when you're an equity holder, you're hoping that the company generates a profit and you see a return through that. For a royalty company, given that we just get a percentage of the miner's revenue, we're not exposed to the operating costs in the same way. There's sort of a binary exposure in the sense that if a mining operation becomes uneconomic for whatever reason and shuts down, obviously the revenue line item then shuts down. You don't see that revenue that you're getting exposure to. But outside of that, you're not exposed to swings in operating cost profile, and that's an important point. In particular, I think it's highlighted when you look at an environment unlike today, where commodities are going strong. But in a downward market where, say, copper is off 10% and you hold a royalty over a copper company or a copper project, you would see your revenue, all other things being equal, you would see the revenue decrease by 10%. Whereas that 10% decrease in commodity price to equity holders getting exposure to the profit line of the P&L statement, that decrease in 10% of the commodity price may wipe out their profit entirely. So it's a different risk profile, but you get the same sort of upside exposure. The reason people invest in mining equities is because, well, rather than investing in just the metals themselves, index funds or whatever that hold the metals, they invest in certain mining companies because they want to see, the projects extend their life or expand the production profile, all these sort of upside scenarios that give you an enhanced return above just getting exposure to strictly the metals. So royalties give you that as well, because if they extend the mine life, they're extending the revenue line item, and we're getting exposure to that. Or if they expand the production profile, again, they're expanding the revenue line item, we're getting exposure. So you get that same sort of upside exposure that drive people to buy mining equities, but you're doing so in a much more risk mitigated type of fashion because you're just getting exposure to their revenue, not to their profit line. And then on top of that, I mentioned it's important that royalties are tied to particular land parcels in most jurisdictions. That's because royalties are registered on the land. They run with the land, such that if the operator went bankrupt, the royalty in most cases survives. Once it's over a certain property, it's there in perpetuity and never goes away. In addition to that, in terms of the cash flow waterfall, they tend to sit senior to equity as well. In fact, we've got one royalty that's senior secured, such that if the operator went bankrupt, not only would that royalty survive in perpetuity, but any unpaid amounts owed to us sit senior above all other creditors. So they've got a lot of inbuilt inherent advantages over directly investing in mining equities that make it sort of have this superior profile. And you can see that this graphic shows the three largest precious metals focused royalty companies relative to a gold miners equities ETF. And I'd encourage you to look at the sector in general, even more broadly than these top three. Obviously, I think what you'd find is most royalty companies almost uniformly outperform mining equities. And it's really driven by the style of exposure that I just described, as well as the fact that a mining royalty company can hold a huge amount of diversification in their portfolio. When you look at Trident post completion of this deal, we'll have a total of 20 assets at a relatively modest market cap. A similarly sized market cap mining company would have one, maybe two assets, certainly not two in production unless they're small. So you get this huge benefit of diversification. The largest mining royalty company has north of 2,000 royalties, whereas the largest mining companies have sort of north of 100, less than 200 assets. So it's a function of that. The inherent benefits of royalties as financial instruments, coupled with the broad diversification that they can provide, that lead to this outperformance relative to mining equities. So then the key question we usually get is what exactly is Trident doing differently from all other royalty companies? Because I just described there's three big ones. In fact, there's more than 20 listed mining royalty companies. And I think this chart really describes it succinctly. You can see on the top donut chart there the breakdown of the global mining sector by commodity. So it's roughly about a third precious metals, a third base metals, which is copper, nickel, zinc, and then a third bulk commodities like iron ore, battery metals like lithium, and then industrial minerals. So you get this sort of broad diversification in the mining sector, but that's completely lacking then in the mining royalty sector. And that was really the driving force for us to set up Trident and structure it the way we did. When you look at the mining royalty sector by market cap, yes, there's nearly 70 billion in mining royalty market cap. So it is a sector that resonates with investors outside of just mining centric investors. People get that it's a good way to get your exposure to the sector and get exposure to real assets and real commodities, particularly in environments like today where you've got inflation at sort of 40-year highs. You want to get exposure to real assets to protect yourself from inflation. You want that to be a substantial part of your personal portfolio. Yeah, mining royalties offer you that sort of exposure and protection. But where you struggle then is if you exclude the sort of 5% that's single asset mining royalty company, so effectively kind of one particularly large royalty in a vehicle that's just passed through as a dividend. If you exclude those, Then you've got north of 95% of the mining royalty sector focused on precious metals. And an investor would be very hard pressed. In fact, I think it would be near impossible to get exposure to the entirety of the mining sector, the full breadth of the mining sector, similar to that graphic at the top, the sort of third, a third, a third. You wouldn't be able to do that from a royalty vehicle that's out there in existence today. And that's really the driving force behind Trident. Is we want to build up a portfolio that's broadly diversified such that investors can have their shareholding in Trident and say, I've got broad diversification to the entirety of the mining sector, but from a royalty perspective, which is the way I want to get my exposure. So that's the sort of mission we started out on. When we listed, we had just a single iron ore royalty. That was 18 months ago. When you fast forward to today, prior to this transaction that I'll be speaking about, we have 13 royalties now. So we've grown from one royalty in one commodity to 13 royalties spreading 4 commodities. We have exposure now to precious metals, to base metals, to battery minerals, and to bulk commodities. And obviously been looking to continue to expand upon that. The other thing that probably jumps out on this graph is that we've got broad geographic diversification. I'd mentioned early on that you'd be hard pressed to find a junior mining company with our size market cap that gives you the sort of diversification that we offer via our portfolio of royalties, because we've got royalties over multiple projects in multiple countries, in multiple commodities. And that's really the critical benefit of a royalty portfolio. So just stopping on this slide to talk to a couple of our existing assets, because I think it'll give everybody a bit of flavor of the quality of assets that we're getting before I pivot to the new transaction. Our biggest asset by far is the Thacker Pass Lithium royalty, which is over the Thacker Pass project operated by Lithium Americas in Nevada in the US. We bought 60% of an existing royalty. This royalty had been written almost 10 years ago now. It was held by a closed-end fund that had a fixed fund life and had to exit. So they sold down part of it. They won't be able to hold it to the point at which they see it into production. So we're keen to start selling down some exposure. I think we'll likely hold the remainder of the exposure once the asset's in construction, and then you see a re-rate in value when that occurs. But this asset is it's the largest lithium reserve in North America. It's one of the largest lithium projects globally. It's a massive project. We knew of the royalty's existence, and previously the challenge we had is, as I said, it's a very huge project, and this is a royalty over the entirety of that project, plus a 5-kilometer area of interest. So if they expand that project, the royalty expands with it. Obviously in a good jurisdiction, being in the US, Nevada, the number 1 global mining jurisdiction in the world, according to the Fraser Institute. So it's a great royalty over a great asset. The challenge we had was that it would be a substantial ticket size for us. And it was not yet in construction. That dynamic changed in January. The operator got their final permit, and now they're going through the final procedural challenge to that permit and expect to have it finalized in Q1 next year, and intend to commence construction in the first half of next year. They intend to have a pilot plant up and running at a steady state by mid-year. So they're sort of off into the races. And then in January, they also raised $400 million in an oversubscribed equity raise to fund construction of the project. So that was really the catalyst. Was it got its permit? Yes, it's got one more final procedural challenge, but it got the permit issued, and then it raised capital. So financing and permitting are 2 of the key critical items for an asset to go into production. So once those hurdles were crossed, then we were very interested in re-engaging on that royalty and acquired it in March of this year. And then subsequent to that, some of the benefits of royalties that I mentioned, if they expand the production profile, we benefit from that. Well, they've done exactly that with Thacker Pass. In October, they announced an expansion of the planned production profile by a third for both phase 1 and phase 2. It's a sort of staged ramp up in terms of production. So effectively what that did is we were modeling a 16% post-tax IRR on this project, which I should point out is 16% year after year after year for a 46-year reserve life. And then the resource is now 4 times the size of the reserve, so ample scope for it to extend its life. Pretty confident in saying it'll likely be a century-long mine, providing lithium, the only substantial lithium mine in the U.S., at least that's advanced at this stage. So pretty critical mineral in a good jurisdiction with a long mine life. When we were modeling a 16% post-tax IRR, that expanded out with their project expansion to north of 20%. And then those numbers were all predicated on a $12,000 per ton lithium price. If you've been following lithium prices, you've probably seen it's run up. It is now north of $30,000 a ton. So comfortably puts our return sort of north of 30%. Obviously, we're not banking those sort of lithium prices in perpetuity for the next 46 years, but I think drives home the economics of this style deal. We bought the royalty for 28 million. There is a one-off payment. The operator can buy down the size of the royalty. It's a bit of a no-brainer that they would do that. So we would expect to see 13.2 million back when they do that. It's in all their studies that occurs sort of before first production. And then at that reduced royalty rate, we're sort of on risk for 14.8 million. At today's lithium prices, we'd be generating north of 11 million a year from this royalty at phase one, and north of 20 million a year at phase two production. And as I said, for 46 plus years. So a pretty phenomenal royalty, and really is a poster child for the strategy. If that was a Nevada gold royalty, given the competition in the gold space, that those kind of returns wouldn't be on hand for companies like us. So it really drives home and underscores, I suppose, the whole point of what we're doing here is that these royalties are out there, and aggregating them into a portfolio to offer broad diversification and broad exposure to the commodity spectrum is really the focus of Trident and what we've executed to date. Just briefly, I'll touch then also on our Lake Rebecca gold royalty, because we do want gold in the portfolio. What we don't want to do is compete with our Toronto listed peers for Canadian gold royalties in most instances. But an asset like Lake Rebecca is in Western Australia. Again, it's grown its resource since we acquired the royalty in September of last year. So it's advancing into studies. It's grown the size of the resource. It's grown the confidence of the resource significantly. So we're seeing movement in the right direction. And then at present now, the operator of that asset is being acquired by Ramelius Resources, which is a good plus $1 billion Aussie mid-tier gold producer. The great thing about Ramelius buying this project is that Ramelius has two operating assets, operating hubs in Western Australia, but no real solid pipeline of development stage assets. So this makes Lake Rebecca kind of the next asset that they would be bringing online in their quest to become, 500,000 ounce a year producer. Lake Rebecca would be a pretty critical part of that. So it accelerates the certainty and the scale of the project in our minds. Ramelius has already said they see this as a 10-year mine life, 10 years plus at 100,000 ounces plus per year. And so on those sort of numbers, the royalty at today's gold price would be generating about 3 million a year. And we bought it for about 5.56 million about a year ago. So I hope hopefully that gives you a flavor for sort of the assets that we're putting into the portfolio. I could obviously go through all of them, but want to spend the bulk of my time on the transaction that we announced last week. The last thing I would like to flag on this slide, though, is you can see one of our soft spots is the fact that of our NAV per broker consensus, only 9% is in producing assets. We've got a producing copper royalty in the Mimbula royalty in Zambia, and then we've got a producing iron ore royalty in the Kulianabing Deception Pit royalty. But the bulk of our value is in assets like Thacker Pass and Lake Rebecca, and there are other high quality assets. The Lincoln mine is meant to have first gold here in the next week or two. That's located in California. Warrawoona is in construction now. Our portion of that tenement is meant to come into production in 2023. So we've got this great development pipeline with a very clear pathway towards these assets being in production. But we suffer from not having many producing assets, and ergo not much in the way of cash flow yet. So that's been sort of our Achilles heel that we were looking to address. Just briefly on this slide, it's always nice to show a slide that's sort of moving up and to the right. We IPO'd at 20p last year, and we're sort of hovering in the upper 30s at the moment. But I think more pertinent, you can see the deal velocity. We've been listed for 18 months, because one of the other questions we often get is the strategy sounds great, but is there a pipeline to actually execute on? And I think with this being our ninth announced transaction in the space of 18 months, so a deal velocity of sort of a deal every other month, I think we can comfortably say that proof of concept is there. The pace has slowed a bit as we sort of pivoted our focus towards production assets and also larger acquisitions. That said, clearly the pipeline's there, and with it comes share price movement and liquidity and all those sorts of good things that you need to have a healthy share price. And then, but last slide before I get into the meat of the presentation, you can see our projected revenue profile here, per broker consensus estimates. And really the weak spot, as I said, is the lack of producing assets, sort of immediate term from 2022 to 2025, in particular. And then you can see that one-off payment on factor pass that sort of reduces the royalty rate that we assume will occur prior to first production. Of course, if it doesn't occur, then that's even better. The royalty rate is exceptionally high, and it's at such a level that it strongly incentivizes the operator to make that one-off payment to reduce the rate. But you can see that's sort of our weak point here is the revenue profile in the next sort of 3 to 4 years. And we'd made no sort of, we weren't ambiguous about our intent to try to fill in that gap, and build up the immediate revenue profile. We've been focusing on producing or very near producing assets. Post-backer pass, you can see that obviously with this portfolio acquisition, almost entirely producing assets. And then even the small transaction we announced in, I think, beginning of September it was, over the Lincoln gold mine. That was the final bit of funding to turn that project on. And as I mentioned, their target is to have first gold before Christmas. So that's been, filling that gap has really been our priority. So now I will jump into sort of the meat of the discussion, the gold offtake stream package that we acquired from Orion Resource Partners. You'll note that Orion this is the third transaction we've done with Orion. Orion's the largest mining private equity vehicle in the mining sector, so the largest PE fund. They're a pretty prolific writer of royalties and streams. So it's great to have them supporting us in the sense that we've just got a great working relationship with them. You know, as they grow their funds, write new royalties and streams, we become a natural outlet for them. Obviously, there has to be a meeting of minds with regards to value. But as mentioned, they're a closed-end fund, so they can't hold these things in perpetuity. They need to monetize at a certain point in time. So to have them on our register as just under a 10% shareholder, I think is a very comfortable place for us. It gives us confidence that when they do write royalties and then they look to monetize those, we'd hopefully be one of the earlier phone calls they make. But it's not such a large position that it's difficult to manage, or that they'd be looking for board representation or anything like that. I should note that some of the previous transactions that we've done with them, they took equity as well. Those are held in a separate fund, and so there is a different sort of duration in life here. The equity that they're taking as a part of this deal is in their funds 2 and fund 3, which have very, very long life in front of them. And our understanding, they've obviously got a 9-month lock-in on the shares for this transaction. But I think the intent is to actually maintain that position for significantly longer than that, such that they have this relationship and a ready, friendly party to engage with when they look to monetize assets. So we're happy with that outcome. But as you can see here, the real critical thing that it does for us is, it takes us obviously from 13 assets up to 20, and royalty companies are heavily valued on their breadth and depth of diversification. But then most importantly, it brings us from 2 cash flowing assets, soon to be 3 with Lincoln turning on, so 2/3, up to 9/10. And it's really the cash flowing assets that drive the premium valuations that royalty companies can get. So that was, as I said, really the issue that we wanted to address with this transaction. You can see some of the other metrics on the tables above, and I'll talk specifically to the return profile in one of the later slides. But almost on all fronts, it does pretty substantial things for us, and a very, very accretive transaction on top of some of these qualitative elements. And then in terms of the actual portfolio itself, I won't go sort of asset by asset. There is obviously this presentation with slides on some of the key assets on our website, and then we also, on our list of assets on the website, you can go asset by asset and review them in detail, as well as there are links to the operators' web pages that have more info as well. But I will hit on some of the key stuff. So it's 7 total offtake contracts. So 7 offtake contracts on 7 producing mines operated by 5 miners, with 50% of those located in the Americas, and then over 60% critically are in the first quartile of the cost curve. So with those not familiar with that terminology, effectively it's a ranking of gold mines in this case, based on their cost profile. And the fourth quartile are the most expensive mines with regards to operating cost, and the first quartile are the lowest cost mines in the world to operate. So with over 60% of this portfolio in first quartile mines, effectively it means they're very defensive assets. The gold price can ebb and flow, and these are the type of assets that don't shut down. It's the fourth quartile that you tend to see mine closures and reopenings as the gold price moves around. It's a very high quality asset base. Of the five operators, the one we're most exposed to is Equinox Gold, so a good TSX listed mid-tier gold producer in the Americas. Really high quality assets. So I mentioned I won't go line by line, but I will sort of flag the first one on this list because I think it's a good example, I suppose, just of describing the portfolio in general. And this is the offtake stream over the Los Philos gold mine in Mexico. So effectively, with this offtake, we get 50% of their gold production up to a cap of 1.1 million ounces. So I suppose the important thing to flag here is Los Philos is a large mine. Equinox has invested heavily into it. They've opened an additional open pit and underground this year and are looking at further expansions. They're looking to ramp it up to north of 350,000 ounces per year in terms of production profile. But in terms of us specifically with this offtake, it's an asset that's got I think it's a 4.2 million ounce reserve and then a north of 12 million ounce resource. So it's then less a question of will it ever get up to that 1.1 million ounce cap on this offtake. I think the answer to that is almost certainly yes. It's really just a question then of, what's the timing for that to occur and what's the gold price over that intervening period. And I think you'd find that most of these are similar. The next one on the list is two producing assets with Santa Luz to turn on in the first quarter next year. So soon to be three producing assets delivering into that offtake, and so on. You can go through these and see they're pretty substantial assets, and just the style or color of money that gives us a really stable, clear line of sight on the cash flow, even more so than I'd say a traditional royalty, which has enabled us to lever it up and to start turning our attention to what an appropriate dividend policy would be. With the sort of certainty around this cash flow profile, it really just enables us to turn our attention to those sorts of initiatives. Of the two private companies on here where there would be less information, Blyvoor Gold is by far the biggest. It's capped at 2.7 million ounces. That said, to reach that cap, we're sort of looking out to 2040. So in terms of a present value of money type element, you'd sort of view that as nearly uncapped. But there is some information on this mine out there. Nomad Royalties has a stream over this project, and this summer published a 43-101. So I think you'd find it's a substantial resources north of 20 million ounces. It's a huge gold project that's turned on in early part of this year, is now cash flow positive as it continues to ramp up. And then the other private one is Allied Gold. It was publicly reported that JP Morgan and I think it was Credit Suisse were engaged to contemplate an IPO in the first half of next year in London. In fact, Allied operates other mines in Africa. Bonikro is probably their mine with the most upside. They're investing heavily in exploration, which is a positive for us because that asset is uncapped in the portfolio, so you get full exposure as they extend the life and production profile of the asset. But hopefully soon to be some public information available, and obviously they expect that to be sort of a north of $1 billion IPO, so we'll be a nice solid mid-tier producer. It is already a solid mid-tier producer, but will be publicly so here once they get their IPO away. So I think some good quality private operators as well. And then in terms of how these actually work, so I recognize they're slightly different from a traditional stream. So a royalty, as I mentioned, is just a percentage of revenue. So about as simple as it gets. You get your whatever 2% of the operator's revenue, and it's that straightforward. A stream, you tend to get, say, making up numbers here, but you say you get 35% of production from the mine, and you pay 20% of the prevailing spot price for each delivery. Well, these are a little bit different from that, in that you still get, say, 35% of production from a given mine, but then you select the spot price that you pay over a quotational period for each delivery. So the example that I've got up on this slide is a 7-day quotational period. This portfolio ranges from 6 days to 8 days, but effectively you get to pick the lowest spot price over that 7-day period. such that you're trying to clip the difference between, as high a gold price as you can over that period, and then obviously the low, and you can guarantee getting the low. So as you can imagine, this is a slightly different style of cash flow in that it performs better in a rising gold price environment. If the gold price is marching up each day, then the point at which you sell that delivery and then you get to pick the lowest price, you're clipping a sort of a wider margin, I guess, per ounce. It also benefits from volatility, as you can imagine. If the gold price is moving upwards and bouncing around pretty significantly, then because you're clipping that difference between the highs and lows, then you see the return from that, and then you still get operational exposure as the assets perform and expand production, pull cash flow forward, that sort of stuff. But that's effectively how these work. And then I suppose the key element is we're getting on average about 3 deliveries a week with this. So that's where you can do sort of the regression and look at how this would perform as a portfolio with that sort of multitude of deliveries, and you can look at historic sort of return levels. So all this is showing here is the 6, 7, and 8 day return. So effectively, if you're clipping, say, between $20 and $30 an ounce on that quotational period, you divide that return by the gold price at the time, and that gives you a royalty equivalent rate. So sort of simplifies things from our perspective in that sense. And what you can see here is then the historic sort of royalty rate return of this portfolio on a weighted average. So in the 1.5 years, which is not exactly the inception of this portfolio, but pretty close, you can see that Orion under their management had gotten about a 1.7% royalty equivalent. So to put that in perspective from our return profile, if we were to maintain that return, it would be a north of 20% post-tax IRR. And then in the 15-year historic weighted average of this portfolio, the 1.56 royalty equivalent rate, that would be more like a 17% post-tax IRR for us. And now what we've been sort of publishing, what you would have seen in the announcements, is a 1.33%. We use the 10-year. A couple of reasons for this. The gold deliveries are sort of heavily front-loaded, so you do see the bulk of the cash flow in the first 10 years. That said, it does extend out to 2040. So it is a long life portfolio, so you do get some broader exposure. It's also generally the more conservative, and given we're servicing debt with this as well as contemplating dividends in the near future, wanted to err on the conservative side here, but you'd find that that's a 12% post-tax IRR at that base rate. And here you can see the ounce delivery profile, and then the 10-year and 15-year sort of cash equivalent or revenue equivalent to Trident from the portfolio. I suppose one thing to flag on this slide is, and I think it's already popped up in the questions, is do you get much operational exposure? Obviously, as they're expanding operations and pulling forward cash flow, you see that style of exposure. I'd mentioned Allied is uncapped. A good example, actually, that sort of pops out on this slide is the light blue piece of the bar that ends after 2030 is the Victoria Eagle mine. Now, that is a capped offtake. That said, the cap is sort of well in excess of the existing reserve. And even since we put these slides together, Victoria announced a project expansion such that starting in 2023, the ounce profile will increase beyond what we're showing here. And then they also intend to extend the mine life from 2030 out to 2040. So we were not hitting that cap in our existing modeling. So with that expansion, obviously you see the operational upside from that. So you do still get that style of exposure. And then I think this slide really drives home what I was describing before. The dark blue is our broker consensus revenue profile based on our existing portfolio. You can see sort of 1.9 this year, 4.7 the next year, 7.4, and so on. And what we really wanted to do is to fill in that gap, given that it unlocks so many of those qualitative things for us. So, first and foremost, the deal needs to be accretive. I mentioned the return profiles we were targeting. It's very much a log normal style return distribution with our 12% I mentioned as our post-tax base case, but then skewing to the right. So it needs to be accretive such that the NAV per share of Trident increases. That's sort of a given. So that's priority number one. But then thereafter, there's quite a few qualitative benefits, and filling in that revenue profile is one of those. You can see that actually this portfolio is almost custom for us, custom made in the sense that it just dovetails perfectly in with our existing profile. as assets like Lake Rebecca turn on in 2023, 24, and so on, and begin ramping up, that's where you see some of these offtakes starting to hit their caps, and it kind of peaks there in 25, maintains good cash flow in 26, and then starts to taper after 2026. But that point in time, our existing portfolio assets have comfortably had time to turn on and ramp up, such that this acquisition allows us to then maintain a really nice steady production or revenue profile. So it slots in nicely. Obviously, it'd be great if all the assets were uncapped, but then we wouldn't have gotten it for the just under 70 million that we acquired it for. So it does quite a bit for us. And as I said, it's sort of the right deal at the right time in terms of how it fits into our portfolio. Again, this is highlighted on this slide. It re-rates us a bit towards precious metals, which wasn't the driving force, but that said, happy to have a bit more precious exposure, particularly given the competition on the precious side of this sector. We have to be a bit creative on how we get that style of exposure, because what we don't want to do is pay up for it relative to our peers. So we have to be a bit creative in that regard. So happy to get some more precious in the portfolio. But most importantly, it bumps that 9% of production exposure in our NAV up to 33%. And this is actually sort of a bit of apples and oranges. So it's pro forma. So I suspect once the research analysts do their work, it'll be a bit closer to 50-50 on a NAV basis. And that's a nice balance to have with sort of that. You can still get those re-rating events. When Thacker Pass commences construction, I'm certain we'll see the impact in our share price. Similar when Lake Rebecca does the same. And these assets, Mimbula, our copper project is right now sort of in construction phase, and will soon be ramping up to 30,000 ton a year profile. So you still get that development exposure such that the stock can re-rate on advancements on your development assets. But then it's sort of got a bedrock foundation of 50% of the NAV grounded in cash flowing producing assets. As I mentioned, 9 of those, soon to be 10. So a good balanced mix there that gives us the style of exposure that most of our investors want. And then what you see here, and I've kind of been through this through speaking to the Trident story, but you can see our at IPO sort of just 18 months ago, we were effectively a cash box. We'd raised 20 million and had a little bit of money from the shell that was previously Trident Resources, and we had one royalty. You fast forward to today, and we're sort of have been bouncing around or just under the 100 mil market cap. These are US numbers, and we're at 13 royalties. And then post transaction, we should be bouncing up closer towards sort of 136 on this slide, and obviously we'd expect to see a re-rating, which is what the chart below is showing, that we'd be trading at quite a discount relative to cash flow if we didn't see a re-rate on our market cap. But nevertheless, with that growth in market cap, obviously no one likes dilution, but if it's dilution for the right reasons, in terms of it's still adding value per share and it's improving liquidity, it enables funds to get on the register that wouldn't otherwise be able to due to size thresholds. I think you'll be pleased when you see some of the TR1s that get published and some of the institutions that joined our register in this last raise. It sort of facilitates those sort of undertakings. And then the last slide before I flip to questions is obviously this isn't the end by any means. We built up a solid portfolio. I think we're moving at a pretty rapid pace, and that's not going to stop. As much as I'd like to take a break, we still have plenty of assets that we're reviewing at the moment. We did flag in the announcement in order to cleanse the market that we are very advanced on a battery metal asset. This one we're in documentation at the moment. Obviously, a deal's never done until it's all signed, but we'd be hopeful that we'll see that one announced in the next few weeks. And it's over an asset that I think would probably be familiar to many of the people on this call. As mentioned, battery metal asset. It's one that's entering construction now. Early works are underway, and will be turning on in the near future. So it fits that profile of an asset that is got a clear sort of pathway to production, and fits in perfectly with our portfolio. So with that, Paul, I think we can pivot to questions.
Fantastic. Adam, thank you very much indeed for the presentation. Ladies and gentlemen, do please continue to submit your questions using the Q&A tab situated in the right-hand corner of the screen. Just while Adam takes a few moments to review those investor questions submitted already, I'd like to remind you that the recording of the presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard on the Investor Meet Company platform. I'd also like to remind you that your feedback is important to the company. Immediately after the presentation has ended, you'll be redirected for the opportunity to provide feedback in order that the company can better understand your views and expectations. Adam, we received a number of questions, both pre-submitted and during today's live event. If I may just hand back to you, and where appropriate to do so, if I could ask you just to read out the question and give your response, that would be fantastic.
Yep, perfect. Thank you, Paul. Let's see. First question I have here is in respect to the possible battery metals deal. On what date does the right of first refusal expire? So on that particular one, at the time of the announcement, the right of first refusal had not yet expired. It has now. So we've got sort of better clarity to that with that hurdle sort of removed. So I think that answers that one. The next one we have is, could you give some indication of revenues that are likely? I think we did that in the presentation, but then it looks like further to the point is, can you give an indication of the depreciation that will offset those revenues from a profitability point of view? And to what extent is that just depreciation discretionary? We've got Martin Page on, our CFO, so Martin, perhaps I'll let you answer this one.
Yeah, sure. I was going to make you answer a question about depreciation, but I'll take that one. That's fine. I guess we'll have to go through the audit process in due course, but based on current accounting standards, we expect to amortize the purchase price effectively just sub of 70 million on a units of production basis. It's slightly accounting techie term, but effectively it's sort of matching the amortization against the production of each of the assets. So we'd look at each of the offtake contracts and what's it delivering into the contract. So for example, if Los Philos delivered 200,000 ounces in a year against the total due ounces of 800,000 ounces, we'd amortize that part of the contract that we valued by 25% in that year. I mean, in terms of discretion, I mean, these are wasting assets, so amortization isn't discretionary, but there's some degree of flexibility on the methodology, but ultimately that's subject to approval by auditors, and it's units of production is a pretty normal basis on which to amortize mining assets, and this would fit the bill. I would note that also that the amortization is fully deductible for tax, so we would get a deduction in our tax computation for that amortization. Back to you, Adam.
Yep. Let's see. The next one on the list is, once the portfolio of offtake contracts completes, will Trident have enough income to obtain a new borrowing or extend the $40 million Macquarie facility to fund future deals with more debt and less equity? Yeah, this is a great question. Actually, I didn't touch on this much on the presentation, much at all. We're obviously restricted given the placement hasn't closed. We sort of can't go into the details of that, but can touch on the debt. So obviously this is a pretty material step up for us. We had a $10 million debt facility with Tribeca, very much a credit fund style facility, but enabled us to sort of do quite a bit with regards to sourcing deals and being able to sort of do so with the security of funding there from the counterparty's point of view. Now stepping up to the Macquarie facility, we're going from a $10 million facility with a 1-year term up to a $40 million facility with a 3-year term. Meanwhile, the cost of capital is decreasing. Obviously, we want to continue moving in that direction. This is just the first step in that process. But as our portfolio gets further de-risked and we add assets, a group like Macquarie that has a massive balance sheet and is very comfortable in the mining sector has the capacity. And then indeed they supported Trident with the intent of expanding that facility such that if everything goes well, then you're not repaying it in 3 years. Within 3 years, it's a larger facility, and the date's been pushed out further for maturity, and that coupon is decreased over time. And it all goes back to this question, which is to try to fund future acquisitions, reliant more on the ability to leverage this style portfolio rather than sort of doing continual equity raises. I think all the management team on this call and then the board as well are very equity focused, equity incentivized. So we don't want to wear the dilution either. But now that we're sort of at the scale and we've got the endorsement of one of the biggest resources banks in the sector to support us, I think not that it rules out an equity raise, but certainly we wouldn't be we wouldn't be looking to do an equity raise in the near future. First off, we want to see the share price re-rate materially from where it is today before we would contemplate that. Let's see. Next question is, what are the main commodities you're considering in the future? Copper, lithium, etc. We've got our VP of Investments, Julian Boucher, on the call. So, Julian, maybe I'll let you speak to that one.
Certainly. So that's also a good question. As Adam mentioned at the beginning of our presentation, in the long term, what we'd like to do is build a portfolio that reflects the broader sort of mining sector in terms of commodity mix. That said, we very much are still in growth mode, with a very strong focus on building shareholder value. So we're not going to be religious about, oh, we've done gold now, we have to make the next one zinc or nickel or copper or lithium or cobalt. We're picking and choosing deals based on the accretion to shareholders, as well as fitting that within any capital constraints that we have at any given time. I think we've got iron ore, we've got copper, we've got lithium, we have gold in the portfolio. We'd love to expand that to some new commodities, but we're pretty open-minded, and the primary focus today is shareholder creation, and noting that while we're growing quickly, we are still fairly small in the grand scheme of things, and every deal we do is going to swing us one way or another in terms of the portfolio mix. So we're confident in the pipeline and confident enough in the future, I guess, that we're not going to get hung up on any one specific commodity sort of allocation at this stage.
Yeah, perfect. Thanks, Julian. So the next question on the list is, could you please explain the details of how offtakes work, both on the buying and selling side? When selling, do you arrange the logistics? And if so, does this mean new employees? Hopefully I covered off sort of the mechanics of how these offtakes work in the presentation. And then I suppose the question, more to the point of the question, is, is there a big burden with regards to logistics? And does that mean new employees and increased G&A? The short answer is no, there's not a material change. We're not sort of taking physical possession of the gold and sort of moving it around. As you can imagine, these are by and large sort of paper movements, and we're trading the gold through Macquarie, so we've got sort of a good supportive, that's their bread and butter. So in terms of trading it through their desk, that's pretty simple. Doesn't necessitate an expansion of our employee base. I mean, that's really one of the key benefits of royalty companies is we've got 4 full-time employees with the revenue profile we referenced in the slide deck, and the breadth of the diversification now in the portfolio. That's you just would never find that in a mine operator, where they'll have hundreds of employees for a single mine in many cases, and with a couple mines they could be well into the thousands. It gets pretty cumbersome and it gets complex. This is a very scalable business model. I always like to reference Royal Gold because they're down the street here in Denver. And I think in their latest presentation, they know that they've got 26 employees, and they sort of bounce around between a $7 and $8 billion market cap. So it's very, very scalable, and we can absorb these assets, get the revenue out of them without sort of this commensurate scaling of G&A. Let's see, the next question, it looks like it's a 2-part question. It says, firstly, should you require to raise more funds for purchases in the future? By what means? Loans, share issuances, etc. Do we prefer? Secondly, whilst we are still at the portfolio building stage, when do we anticipate reaching the point that we can start paying dividends? And do we favor monthly, quarterly, half-yearly dividends? So on the first piece, I hope I covered that off on one of the earlier questions with regards to how we're approaching sources of capital going forward. We'd be looking to maximize leverage. Obviously, doing so, taking a balanced approach. Obviously, no one's incentivized to max leverage to the point where it becomes unmanageable. But yes, relying on debt where possible. It just improves investor returns and minimizes dilution. A share issuance, it's all going to be sort of deal dependent, but as I said, we would need to see a significant re-rating in the stock, I think, before we look to do our next equity raise. And then in terms of timing of how of paying dividends, it's going to be a bit of a function of, we want to see these assets perform for a couple quarters, obviously. You need to make sure that the revenue is stacking out the way we'd expect it to. We also have sort of the typical debt covenants that you'd expect to see with a term facility. So there's some of that stuff that needs to be considered. But by and large, the board has started turning its mind to the proper timing of a dividend, looking towards potentially the latter half of this year. In terms of the actual construct, monthly, quarterly, half yearly, I err to say that it will likely be quarterly. That said, that's some of the work that's ongoing now that we'll be integrating this cash flow. We need to look at the appropriate dividend policy. Most of our peers tend to do sort of a percentage of free cash flow, so somewhere between 20 and 30%. I'd suspect that we'd probably be erring on the more conservative side initially, but that's the framework that most royalty companies typically approach dividends. Let's see. Some may say you're buying, expanding your portfolio at the top of the mineral cycle. What would be your comments on that? Take copper, for example. How do you maneuver in a market that's topping out, if you agree it is topping out? Yeah, no, that's a really great question. And it really comes back to Trident's strategy in general, which is with most of our peers focused on precious metals, they really get themselves stuck, particularly given there's so much competition in that particular sector. But they're stuck looking at only one commodity, and you find yourself in this position where, as a public company, you either kind of do nothing, you think the deals are overvalued, you can't get there on price, so you do nothing, and that's not what investors want to see. Nobody wants us to sort of sit on our hands and just wait. But equally, you don't want to go out there and then do bad deals just for the sake of doing deals. So you're in this really uncomfortable position. Trident being diversified, we can find value across the entire sector. And whereas copper may be running hot at the moment, gold's been relatively flat for the last year, and this offtake portfolio is obviously a slightly unique, such that we were able to get really good value on it. But you can see it in the style of deals that we've done. We're not pricing in sort of compete commodity prices now. If we were to do that, then the deal likely wouldn't make sense for us. But we've just got the flexibility to pivot to other commodities, and to really and just to approach it in I suppose a less sort of siloed fashion than many of our peers. So that's been the great thing about this vehicle. And in the early days, one of the questions was frequently, most of your peers are precious metals. How do we know that this strategy will work? And I think we're starting to see that now. Whereas the precious guys are sort of fighting each other fiercely for this sort of small pool of deals, we're able to go out there and do something slightly different, and we're seeing the returns from it.
And Adam, perhaps I could just jump in just very, very quickly on our process. We don't, when we sort of evaluate these assets, we don't just take today's spot price. Obviously, we sort of look at various forecasts, and the key for us is to make sure that our shareholders don't lose money in a downturn. We know that the commodities generally and mining is cyclical. I think Adam had mentioned when we did Thacker Pass, we had sort of a $12,000 per ton long-term lithium. So we do sort of take these things into consideration, and it goes well into our pricing.
Yep. Yeah, that's helpful. Good. And then next question, let's see. Are you interested in investigating new opportunities in the EMEA area? So for those not familiar, that's Europe, Middle East, Africa. For example, gold mines and other assets in Africa. Julian, actually, I'll let you speak to this one as well.
Yeah, no problem. So we're quite open-minded about jurisdiction, but we do have limits. And I think there was another question further down about sovereign risk acceptance, that kind of thing. And the key, we've throughout our careers, we've sort of invested across jurisdictions. The key for us is picking jurisdictions where you have a good regulatory framework for mining, which includes security of tenure. It includes sort of the right framework for mining royalties specifically, as well as the ability to repatriate capital. So generally speaking, we're probably not really sort of rushing off to Russia It'd be sort of certain places are just not going to be possible for us. Obviously, even in places that we would go to, key focus is always who our operating partners are. I think groups like Equinox, who features prominently in the offtake portfolio, groups that we know personally and have worked with in the past. We know how they operate. We have a lot of trust in them, and I think that's also a key part of it.
Next one is, what is your sovereign risk acceptance profile going forward? It's easy to get greedy if returns look good on paper, but also easy to get your fingers burnt without a set risk profile. This is partially covered, I suppose, by Julian's answer on the EMEA or Africa specific question. We're very conscious of sovereign risk. Having come from mining private equity funds, we've done deals in all continents, say for Antarctica, and we've seen some of these jurisdictional issues that can burn investors' fingers. We have seen it as far as outright expropriations, and obviously the very clear damage that can be done there. But then the more sort of insidious, creeping tax rates or fines for breaches that the operator wasn't aware even existed and maybe didn't exist. So those sorts of sort of gray zone type encroachments. Very conscious of that. Now, royalties obviously tend to be one step back because you are getting exposure to the revenue line item. So a frequent sort of means of pulling out economics from a project in a riskier jurisdiction is for the local government to increase tax rates, specifically targeting mining, in some cases specifically targeting a project. But royalties get a percentage of revenue, so you sit above that. So in many cases, you can sort of avoid the direct impact of some of those initiatives. But to answer the question, it's something we're very conscious of. We like the fact that this portfolio is 50% in the Americas, with assets in Canada, the U.S., Mexico, Brazil, good mining jurisdictions, and even South Africa. It has challenges obviously as a jurisdiction, but it's a good established mining jurisdiction in many respects. So it's sort of one of the foremost things when we initially look at an opportunity is to evaluate the jurisdiction and whether it's a jurisdiction we're willing to entertain. In light of the current producing acquisition, how significantly is this in bringing forward the date in which you're likely to pay a maiden dividend? I suppose I touched on this a bit earlier with one of the questions. It'll be guided to a certain extent by how these assets perform, how the risk profile of our portfolio in general. If Thacker starts construction in the first half of this year, that's a massive de-risking event from our perspective. And then ensuring sort of debt coverage ratios are comfortably covered. That sort of stuff is going to ultimately guide the board's decision. But yeah, the objective is sort of before the end of the year to start looking very strongly at an inaugural dividend. I think almost as much to signal the intent that the purpose of this vehicle is to build up a portfolio such that the cash flow can flow through to investors. That if you want exposure to these commodities, that you're getting that direct exposure because you're getting your dividend delivered quarterly. That's the whole point. That's we've got a balance to strike because obviously we're also in a growth phase. We want to continue to grow the portfolio. So we're conscious of striking that right balance. We want to get there as aggressively as possible because we recognize it'll open us up to different pools of capital that have a yield requirement. We're also conscious that it would likely be a re-rating event for the share price as well. So I'm very focused on it, but just want to do so in a measured, sort of appropriate manner. And then the last question that pops up on the list is, you refer in the presentation to possible M&A to consolidate the royalties market. Could you please expand and provide more details? Yeah, Julian, maybe I'll let you speak to this one. I'll sort of start by saying that clearly if you've looked at the royalty sector and part of the opportunity set that we saw when we launched Trident was, if you rewind the clock sort of 15 years, there would be kind of the big three that are there now. It was just sort of 3, maybe 4 royalty companies. And then you fast forward today and we're sort of north of 25 royalty companies. So, and part of that is that it's become a natural expansion in the mining finance landscape. You'd be hard pressed now to find a mining company that doesn't contemplate a royalty or a stream or offtake financing when they're looking to bring their asset into construction. So it's proliferated with regards to its share of the mining finance world. That said, I think the performance of those early companies in particular has also driven quite a bit of interest, and hence you see quite a few royalty companies, particularly in the last sort of 5 years, popping up. And that was, I suppose, it's not lost on us that this model, as I spoke to, it benefits from scale. So the ability to do some smart M&A such that you're combining assets, building on that scale, the G&A by and large stays the same when you're doing that. You just get this sort of acceleration with regards to equity returns with regards to scale. But Julian, there's been quite a bit sort of on that front. You could, I'm sure, add to this.
Yeah, certainly. I think the M&A side of things is obviously something that's been bouncing around the market quite a bit. Even just today, actually, Gold Royalty Corp announced that it was intending to make what looks like a hostile bid for elemental royalties, or certainly, yeah. So M&A is definitely present in the sector. We're a little bit of a different animal, having our diversified focus. But that doesn't mean that, as Adam mentioned, with a lot of these smaller guys that maybe have stagnated or otherwise having a bit of trouble, some of them do have good assets, and if it makes sense, then we'll look at these. On the diversified side, there are a couple of players popping up. Obviously, there are a few that have been around for a bit longer. And we keep our eye on all of these things. So there is an opportunity. I think we've shown ourselves to be quite open-minded and creative in the way we do deals. So we'll have to sort of see what happens with time, I guess. That's the easiest way to put it.
Yep. Perfect. Now, I think that was the last question we had, Paul.
Indeed, you've been perfect. Just over the hour as well. Look, guys, thank you very much indeed for addressing all the questions we've had come through. And of course, any further questions that do come through, the team will be able to review those. And as always, we'll publish the responses where appropriate to do so on the platform. Adam, perhaps I could just ask you just for a final few words just to wrap up before we redirect the attendees to give you some feedback, if possible.
Yep, of course. No, I wanted to thank everybody, obviously, for attending the webinar today. This was a monumental transaction for us. I don't think that's been fully realized by the market yet. Part of it down to the time of year, I'm sure. People are away from their computers. But we got a lot of support from institutional investors, and we got a lot of support from the retail investors through the primary bid offering last week. So I think we're really pleased with the direction that this is going. I hope our shareholders are as well, and we're going to start to realize the benefits over it of this transaction, as well as the other transactions we've done over the course of 2022. So, and we're obviously not done yet. So we'll keep adding to the portfolio and expanding the offering, and pretty excited about where things can go from here. So thanks everybody for joining. And as always, our inboxes are always open. If you have any other questions that we didn't address, feel free to email me directly, and I'll get back to you.
Fantastic. Adam, Martin, Julian, thanks again for updating investors. Could I please ask investors not to close this session? You should be automatically redirected for the opportunity to provide your feedback in order the team can better understand your views and expectations. This will only take a few moments to complete and is greatly valued by the company. On behalf of the management team of Trident Royalties PLC, we'd like to thank you for attending today's presentation. That now concludes today's session. Thank you and good afternoon.